Trade finance hits at the heart of emerging markets growth in the face of intense regulatory pressure. How has the marketplace and landscape evolved? John Ahearn joins me with his thoughts. Let's start with Basel III. Bankers are saying they're hampered by regulatory rules that don't allow them to do what they do best. What do you make of that argument?
I think you have to take Basel III and put it into different contexts, right? So if you look at it from a framework point of view, it actually is very, very good. Again, if you go back to the 2008 financial crisis, there clearly were a variety of ills in the system and things that were way overdone. But when you take that conversation and now you flip it on to the trade conversation, trade is lending to real world economies, right? It was never a speculative business. It was never a highly leveraged business. And unfortunately, you're linking all of these products together. When you start looking at, some of the subcomponents of Basel III, like liquidity coverage ratios, you start looking at the capital requirements and where the capital requirements are going over the next couple of years and really starting to take impact in 2018, 2019, what you're really seeing is it's starting to impact the world as we know it today, right? A lot of companies, a lot of banks are pulling back their balance sheet. We have excess liquidity in the markets because of the quantitative easing that's been going around the world. So you've seen a period of easy lending. Now, as we get closer to the implementation of Basel III, you're going to start seeing those lendings tighten. And I think you're actually going to go into a drought as we go forward into 16, 17, and eventually into 18.
The liquidity is there. You just have to find the opportunities. So is the real issue that banks are not accurately assessing the opportunity costs?
When you say the liquidity is there, I think you have to go back to the fundamentals of liquidity. Is this real liquidity, or is it liquidity that's being created by the central banks because of all the quantitative easing? The other thing that's very interesting is you're seeing liquidity moving out of the emerging market quite dramatically. If you go back and you look at what happened, the Fed zero interest rates, Europe negative 40 basis points interest rates, you saw a lot of liquidity move into the emerging markets, short term, looking for yield. We've now gone through a pretty major currency revaluation. You're starting to see, some of the emerging market economies slowing down. You're now starting to see that liquidity drain out of those markets pretty quickly. The second thing that's happening is, at least in my mind, the current credit cycle is changing, right? You're seeing low commodity prices for a fairly long period of time. You're starting to see a lot of companies that are hitting financial stress. So yes, the liquidity may be there, but it may not be in the places that you want it, number one. Number two is the credit quality that you want to lend to may not be there.